A trading system that prints money this year can bankrupt you next year, even if your execution is absolutely perfect. Most traders believe that a losing streak means they made a mistake. But often, the error isn't in the trade. It's in the system's inability to recognize that the ground has shifted beneath it. The first and most common failure mode is market regime shift. Markets are not static. They cycle through distinct phases. A strategy optimized for a strong bull trend will bleed capital during a chop or a bear market. We categorize these as trend, range, and chaos. If your system is a hammer, it fails when the market becomes a screw. You must identify which phase the market is in before deploying capital. Failure mode 2 is volatility pricing. Option strategies often rely on implied volatility reverting to the mean. However, IV is not just a number, it is the price of insurance. When IV ranks stay elevated for months, selling high stops working if the realized move exceeds the premium. Conversely, buying options in a volatility crush is mathematically difficult to overcome. The third failure mode is internal execution decay. Over time, strict rules soften into guidelines. You take a trade that looks good despite missing a criteria, or you slightly increase leverage. This is style drift. It invalidates your backtesting because the system you are trading today is no longer the system you designed. The math of your edge evaporates with every small rule violation. So how do we future-proof a system? We don't try to predict the market. Instead, we engineer adaptability using 3 specific mechanisms: gates, bands, and audits. Fix A is environment gates. Before any trade signal is processed, it must pass a regime filter. If the VX is above 30, trend-following logic is disabled. If the market is ranging, breakout logic is locked. Fix B is parameter bands. Avoid optimizing for a single perfect number like a 14-day RSI. Instead, design for robustness across a range. If your system works at 14, it must also work at 12 and 16. Fix C is the process audit. This is a weekly feedback loop where you review execution, not just P&L. You must measure your adherence to the rules. If adherence drops, you stop trading until it is fixed. A robust system isn't one that never loses. It's one that survives the inevitable shifts in the market landscape. In the next video, we will build your personal decision matrix from scratch. Next, we build your personal decision framework based on constraints.